to speak with you today. Our part of the presentation is going to be just kind of a general tax update, and then I know the presenters are doing some tax planning opportunities and regulatory issues. My name is Steve Bishop. I'm a principal with the Assurance Services Group of Beta Martin. John Blanchard is joining us from our Kentucky office. Actually, we just have one office, but he's working remote from Kentucky. And John is a manager with our tax practice.
Thank you all for having us.
So, again, we're doing the general tax update, and as Kirk said, there's been a lot of activity in the last, well, actually since the last camps update that we had last year. So here's our agenda. We're going to be talking about the Setting Every Community Up for Retirement Enhancement Act. That is acronym SECURE. Everyone's pretty much available or aware of the Coronavirus Aid Relief Security Act, the CARES Act. The new one that just came out in December is the Consolidated Appropriations Act, the CAA. And then we have a few other new tax issues for your consideration as we move forward. So the SECURE Act was enacted back in December of 2019. It actually has multiple effective dates, but the majority of them became effective January 1st of 2020. I think there's 29 total provisions within the act, but there's kind of 4 that are key for that we're going to highlight today. Basically, the act modifies the required distribution rules out of qualified plans. It expands retirement plan access. It also increases lifetime income investment options. And then it provides some plan sponsor tax credits. So some ways that you can save money if you're an employer sponsoring a qualified plan. So for RMDs, the prior rule was as soon as you turned 70 and a half, you had to begin taking distributions out of your qualified plan over your lifetime expectancy. And with the new plan, it became effective January 1st of 2020. That age is now moved to 72. Now, the downside is if you turn 70 and a half prior to the end of 2019, it does not apply to you. However, the CARES Act allows you to not take an RMD for 2020. So there's still a little bit of relief, even though you might have turned older at that point.
So the reason I want to know is the distributor versus.
Hey Jake, could you mute your
exclusivity within the territory?
Deal?
Distributors just have a right to buy our.
Thank you. Okay, now for inherited plans. They've also changed that. This one is actually, well, it's kind of interesting. It's not necessarily a benefit. The old rule allowed you to, if you inherited a plan, say a family member passes away and they had an IRA, you could take the RMDs that were required under that plan and now stretch them over your remaining life expectancy. The new rule says that you have to complete the RMDs within a 10-year period. They don't have to be rateable, so you could do it all in one lump sum, presumably waiting until the end of the 10-year period, but you still have to finish it within 10 years. And then surviving spouses, minor children, and people who are not more than 10 years younger are generally exempt. So make sure you kind of check the rules for that. All right. For expanding retirement plan access, the new rule allows individuals who are self-employed to continue to make contributions to their IRAs past 70 and a half. The old rule said that you had to stop at 70 and a half. So now, as long as you're continuing to earn income, you can still contribute to your IRA. And given that the RMDs don't start until 72, that's a benefit that people could look into. One of the significant provisions is if you're a small employer and you found the administrative burden to be too much to set up, say, a 401k for your employees, the new act allows you to band together with other small businesses to form what's called a MEP, a multiple employer plan. And there's a provision where there will be a administrator that takes a lot of that administrative burden off the employers to set up that plan. The other increased access to plans is ERISA, which was the original Retirement Act, allows employers to exclude anyone who worked 1,000 hours or less per year and had not attained the age of 21. The new rule allows part-time employees to join a plan if they've worked at least 500 hours a year over a 3-year consecutive period and have become the age of 21. So it's basically allowing part-time people to gain access to plans. There's also a new form of penalty-free distributions. Under the old rules, we had hardship withdrawals that people could qualify for. Now you can take out up to $5,000 per child for either childbirth or adoption expenses. You just have to do it within 12 months of the event. Those distributions are still subject to regular tax, but they are exempt from the special 10% penalty. This last provision, talking about increasing lifetime income, a lot of people are familiar with annuities as a investment choice. And basically you contribute money right off the bat to, say, an insurance company, and then that annuity will guarantee you a certain amount of income for the rest of your lifetime. Those sound really good. I would encourage everyone to really investigate the pros and cons of those. They do tend to come with higher fees. But the insurance companies lobbied pretty hard for this act to get, it allows plans to include annuities as part of the investment options. All right. The last issue is some plan sponsor tax credits. If you're a small business owner with 100 or fewer employees, you can receive a tax credit of up to 50% of the costs of starting a retirement plan, up to $5,000 for each of 3 years. So that may create some good incentive to start a plan if you do not already have one. You can also get a $500 tax credit for 3 years for automatic enrolling employees. That's been a provision that's been around for a little while, but having an auto enroll feature in your plan can now get you some tax credit dollars. All right. So with that, I'm going to turn it over to John, and he's going to talk about the CARES and CAA Acts.
Great, thanks for that introduction, Steve. Hope you all can hear me well. So the portion that we're going to be moving on to next is the CARES and Consolidated Appropriations Act of 2021. And the CARES Act was enacted in March 27th of 2020, and the CAA, as you all probably are well aware, was passed right at the end of the year. So that made doing these slides even more fun with all these new regulations. But some of the key areas we're going to be focusing on here are the PPP loans, the stimulus checks, unemployment benefits, and some other tax issues. But before we do that, let's start with a little polling question, if you wouldn't care, and just use your little chat box and type in one of the options that we're going to present here. Did you apply for and receive funds with either the EIDL or PPP programs? So option A would be yes, and we move through these funds as quickly as received. B, yes, and we still have some of the funds remaining. C, no, we do not qualify or did not need. Or D, what in the world is EIDL or PPP? So we're going to probably move on, but it'll be just nice to see and keep people involved in what results we had in this poll. So moving on to the loan application period, the original round of the PPP expired on August 8th of 2020, and everybody was waiting for the next round or what would happen, or would we get a new round? And that came through with the CAA. So the second round reopened and expires on March 31st, 2021. And also to mention here, the EIDL, the deadline to apply is extended to December 31st, 2021. Those loans for the EIDL aren't as favorable, so the only reason that a lot of people were applying for it was if they didn't qualify for the PPP. In the EIDL, the interest rate ranged from 2.75% to 3.75 with 30-year maturities and 1-year automatic deferral before payments began. So moving on to the original Paycheck Protection Program, it's a forgivable business loan, 1% interest, 2-year term. And it was intended to help businesses retain employees and cover certain operating expenses. And the original idea was an 8-week covered period to establish and forgivable expenses, and with a minimum of 75% payroll, 25% maximum of these other expenses. And then later in June of 2020, they changed the rules and allowed 8 to 24 weeks and changed the payroll from 75 to 60%, which is more tenable for most taxpayers. And the maximum out of pocket other expenses was changed from 25 to 40%. And the term for loans after 6/30 could be 2 years or 5 years if you entered into that agreement with the lender. So fast forward now to the PPP-2. It's a second draw of forgivable loans for harder hit small businesses, certain nonprofit organizations, housing cooperatives, sole proprietors, independent contractors, and others with 300 or fewer employees. So the maximum loan is $2 million, and the choice of a covered period. This is key here where, again, previously it was the 8 weeks and then they changed it to 24. Now taxpayers are able to choose their window as long as it is greater than 8 weeks from the date of the distribution and not more than 24 weeks. The CAA protection program, again, similar to the prior slide, and we see 1% interest, 5-year term, and to provide working capital for these smaller businesses. But one of the key provisions here is a lot of taxpayers were complaining about, hey, you're putting these smaller categories for the maximum others. And there's so many other items that we're encountering now with COVID-19. So legislation was passed to change that maximum other category and include these 4 other categories that weren't previously included, but businesses are definitely experiencing. So these new categories of 40% forgivable expenses are covered operation expenditures, and those include payments for software, cloud computing, other human resources, or accounting needs. Covered property damage costs consist of expenses related to property damage caused by public disturbances in 2020. Covered supplier costs are expenditures to suppliers under a contract, purchase order, or other goods in effect prior to taking out a loan that were essential to the borrower's operations when the expenditure was made. And last, the covered worker protection expenditures, and those include payments for personal protective equipment, adaptive instruments to help companies deal with new legislation, both at the federal, state, and local level. So I want to go over here briefly a simple example of the calculation for how much PPP could you qualify. If company A had an average monthly payroll in 2019 of $100,000, how much would a small business qualify under PPP-2? So in this circumstance, they have $100,000. The allotment for normal businesses is 2.5 times the cost of your payroll, and they would qualify for $250,000 of PPP. However, if they were a restaurant, other qualifying food business or hotel, then they can qualify for $350,000 because those types of businesses get 3.5 times the payroll amount. We'll be moving on now to the PPP loan forgiveness. And in this picture, it's the man is the federal government, and they're throwing funds at the taxpayers to help out where they can. And we will have another polling question if that's all right. So have you applied or plan to apply for loan forgiveness on either EIDL or PPP? And the answer, yes, took some time, but we got through it. No, we were waiting to see if the government would make things a little simpler. And C, you mean this is free money? Now, I wish I could see the answers, but this presentation mode limits me, but I'm guessing that there is a little bit of A and B, which I would expect. And if you've answered B, hopefully some of these next slides will help alleviate some of your questions, but there is still guidance to come. So important forgiveness dates to note here. The SBA started accepting loan forgiveness applications on August 8th, 2020, and forgiving loans on October 2nd, 2020. The application forms, we're going to go kind of quickly through these because it's not really necessary to throw a bunch of form numbers at you, but the main form is the 3508 for loan forgiveness. Then they came out with a 3508EZ, and that's a simplified loan forgiveness application for certain taxpayers. And last, and what they've anticipated most taxpayers fall into, is this simplified bucket, and it's a streamlined loan forgiveness application for small businesses, and that's the 3508S for borrowers with PPP loans less than or equal to $50,000. Again, I want to just reiterate, this is related to the original PPP. PPP2, we're going to get into here in a moment. The PPP loan forgiveness application forms must be completed within 10 months of the end of the covered period to avoid payments. And you must maintain documentation. We're all familiar with this. If you file taxes, are keeping records for your purposes anyways, but for the purposes of the 3508S, there's a retention period of 6 years. And I think that retention period's for most, if not all of these forms, but you want to check with your lenders and the SBA if you have questions on those. So with that PPP2, like I alluded to, there are forms to be released, but everything's still to be determined because of the legislation being passed at the end of the year. The SBA has up to 30 days to comply and figure out what they're going to do. But based on the scuttlebutt on the internet and the AICPA and how people are opining at this point, it's looking like it'll be that 3508S for borrowers with loans less than or equal to $150,000. And lo and behold, when I was doing my practice runs this morning, there are already new guidance issued as of yesterday, the end of the day. And all the craziness, there was still something happening for these new guidance, and it's interim final rules related to business loan program temporary changes. And there's a combining of old rules, new rules. So if you're curious about those, you may want to dig into and make sure that if you're accepting these PPP loans, that they may affect you, these new changes. So calculating the PPP loan forgiveness, the max forgiveness loan amount is equal to the loan amount. You must use all the proceeds for eligible expenses during the covered period, or only partial forgiveness will be attained. Subject to the salary test and full-time equivalency employee test or safe harbors. The salary wages test, employees earning less than or equal to $100,000 in 2019, and you would compare that to Q1 of 2020 and not reduce more than 25%. For the full-time equivalency test, you would, as a business, have to maintain the number of FTEs in a covered period and exclude employees that declined to offer. Obviously, some people have experienced that. I know several of my clients even experienced that. But there are other methods to get to those figures. And I wanted to mention here that these FTE calculations, if you've not gone through them, several payroll providers, if you're not doing payroll in-house, are helping with these calculations. Salary and FTE safe harbors, the grace period, if the test is met, need to have been completed by December 31st, 2020. And the FTE safe harbor, the grace period to restore your number of FTEs was December 31st, 2020. New safe harbors, no reduction in forgiveness. If you were unable to hire employees by December 31st, businesses couldn't restore their activity due to government requirements. There are ways to document that, and you'll want to have in your records. PPP loan amount forgiveness. So again, it's the lesser of the loan amount. The payroll, there's the payroll percentage applied by dividing the eligible payroll cost by 60%. And last, the modified total rule. Payroll, non-payroll costs, less salary wage reductions, multiplied by the FTE reduction. All this is, I know, complicated. So if you have went through it, you know what I'm talking about. And if you haven't, there are examples on the SBA's website, as well as lenders I know have been very helpful. Or you can always contact us. We'd be happy to help you. So on to the PPP loan accounting. Steve is going to take back over and discuss this portion.
Yeah, so we've been receiving questions from clients on how to account for PPP loans because it's a little bit different scenario, especially when you're talking about for-profit companies. And most of the questions center around when to recognize forgiveness, if you know, if a company has received some assurance that that they're going to get it, but they haven't yet got it, you know, how does that factor into your financial statements? So the guidance that's out there right now is that a for-profit company would record it under ASC 470. That's the Accounting Standards Codification. I'm going to talk a little accountantese here for the accountants in the audience. You're going to record the debt forgiveness under ASC 405-20-40-4-1. Now, kind of the interesting part about this is our AICPA has what is called the Center for Plain English Accounting, if there is such a thing. And they came out with a technical question and answer deal that was talking about that for US GAAP, there's really no specific guidance on point to when to recognize the forgiveness. So they're talking about that you could potentially make an analogy to the International Accounting Standards guidance standard number 20, which basically says that if it's probable you're going to get the forgiveness, you can go ahead and recognize that at the time that that is established. However, if you don't meet that probability threshold, then you would default back to the ASC 470 guidance. So, you know, coming from the Center for Plain English Accounting, not necessarily exactly plain English, but that's accountants talking to accountants. So, you know, I think you're going to have to evaluate your facts and circumstances. Know that that's out there that you could potentially use. When you do recognize it in your financial statements, we recommend showing that as a separate line item under your other income and expense, because it will be a gain at that point in time. Also, you should not be imputing interest on these under ASC 835-30-15-3E. Okay, John, let's jump to the next slide. So I know Camps has a nonprofit member. I'm not sure if they're in attendance today, but there is some guidance that depending on the facts and circumstances of whether management is anticipating forgiveness, they could either use ASC 470, otherwise they should default to ASC 958-605 and treat the loan as a conditional contribution, basically treating it as a grant that is subject to certain criteria. And then once those barriers to the recognition criteria are met, you could go ahead and record the forgiveness. So back to John, I think.
Yeah, thanks, Steve. Appreciate that. So the tax guy is going to talk about income tax considerations here. And the loan forgiveness amount is not taxable. And the expenses used to qualify for forgiveness are now deductible. As as most of you are probably aware or not, during 2020, there was a big talk about why taxpayers would be helped, and then we're going to hurt them on the back end when they have to pick up all this income and not be able to deduct the expenses. So the expenses now with CAA 2021 are deductible, and people won't have those huge increases in taxes with disallowed deductions. Moving on to the stimulus payments, and we're going to be talking about the individual side of things. So the economic impact payments, if you were able to receive those or are aware, it was $1,200 per adult or $500 per child, with AGI phase out thresholds as follows. And the qualifications for the economic impact payments are Social Security number valid for employment, resident alien, not claimed as a dependent, and you are alive. I say that because that was a huge debating point. People were getting checks that had died, and Congress did not want that to happen again. So we're going to fast forward then talk about the second round of economic impact payments. And it wasn't as fruitful for the people that qualify, but it's $600 per adult, $600 per child, with the AGI threshold staying the same, except for the previous ones, you're able to base that on your 2018 AGI or your 2019 if you had already filed. But now this new round is based on taxpayers' 2019 AGI. And of note in this section is the threshold stay the same, but they added the category for surviving spouses fall under the same level phase outs as the married filing joint. So surviving spouse is now $150,000. The qualifications stayed the same, so you don't need me to throw that back at you. On to unemployment benefits, and we've split this section into two pieces, the CARES Act and the Consolidated Appropriations Act. So there was an extra $600 weekly benefit between April 5th, 2020 through July 31st, 2020. An additional 13 weeks of unemployment benefits were granted for covered workers not eligible for benefits under state law, and it's set to expire December 31st, 2020. So this extra payments were addressed, but not as, again, fruitful for people on unemployment benefits with the CAA, and that's an extra $300 rather than the $600. And that's from December 26, 2020 through March 14th, 2021. And that's up to an additional 24 weeks of unemployment benefits. And again, it's covered workers not eligible for benefits under state law. And this expires March 31st, 2021, with the pandemic unemployment assistance or PUA payments allowed through April 5th, 2021. And we're going to be talking about some other CAA items, and then we'll finish up with just some other miscellaneous items that we think are really important to think about with your businesses. So the required sick leave credit, what is it? It's a payroll credit for employers to take against OASDI tax or RTA tax. The credit was effective as of April 1st, 2020 and spans through December 31st, 2020. And it's available to eligible employers who have fewer than 500 employees. Employers can take the FFCRA tax credits through March 31st with the new regulations that were passed. And I'm going to be presenting you with a really nice chart, but not diving super in depth into it, just for your records when you have the support of these slides with the download. Just want to note that there's a difference based on the categories that certain employees' reasons for leaving would fall into, and you would want to analyze and make sure that they're getting the right benefits for what categories they qualified for. So the required paid family leave credit, very similar to the previous sick leave credit. The required paid family leave credit is payroll credit, which employers may take against, again, OASDI and RRTA taxes imposed. And it's also able to be taken through March 31st, 2021. So there's tax ramifications for this, and the amount of the credit claimed is includable in gross income. There's an example. I, again, won't go over the example for timing purposes, but I think it's a good one to consider when you're reviewing your materials. There's a section 45S credit, a qualified family sick leave wages excluded. And I want to note here that there's an option to elect out if you so choose. Moving on to the Craft Beverage Modernization Act. I know that there are several members of camps that qualify and fall into these categories. And while some aren't on here, the ones we'll focus on today, there is an impact on beer and reducing excise taxes, as well as impact on wine and hard cider. But we'll look at the impact on distilled spirits because of Heritage Distilling is on the call today. So, and the impact, I'm sure that they're well aware, their excise taxes would have been drastically increased if this CBMA didn't increase. But because of the CAA, those rates were made permanent, just like all of the other previous slides that we didn't cover. And these tax rates are very favorable to taxpayers compared to the large tax burden that would have been bestowed on them. So the last thing of this area is these extender provisions. And as most taxpayers are aware, there's a little wrestling move that's done every year between Democrats and Republicans for bringing people to the table. And it's usually for budgetary purposes, but usually knocked on top of the budgets are these extender provisions. And there are several of those this year. And for the year one opportunities, there's charitable deductions limit moved from 10% to 25%. Individual cash charitable deductions have the 100% AGI rule enacted. So for 2020 and 2021, certain cash charitable contributions made by individuals qualify for a complete offset of taxable income, which is great. Energy efficient home tax credit, a refundable employer payroll tax credit, and a retention credit for Q1, Q2. The 2-year extenders, and we're going to talk about this next one here in another moment, but the 100% restaurant meals deduction is obviously beneficial. The health and dependent care flex spending item was extended for 2 years. The 5-year items were the employer tax credit for paid family and medical leave, the WOTC, the new markets tax credit, tax-free employer paid student loans, and the made permanent items of note would be the Section 179D deduction for energy efficient commercial building property, and unreimbursed medical expenses remain at 7.5%. And if you recall, it was going to go back to the old 10% rule, but with this made permanent, now medical expenses will be left at the 7.5% for individuals. And the last section will be covered is just other hodgepodge items that were passed and enacted in 2020. So the final regulations were issued for meals and entertainment, and as taxpayers should be aware, or if you've already changed your general ledger for these changes, that probably included creating new pools of meals and entertainment, whether it's 100% deductible, 50% deductible, or not deductible at all. And most entertainment deductions are disallowed, but there was final regulations issued that include more examples and provide clarification where taxpayers were not sure what was going on with some of their expenditures they were seeing and why or should it not be deductible. And moving on to the item that we talked about just a moment ago, the meal rules for 2021 and 2022. So if a business provides meals or has a business meal from a restaurant during this period, it will no longer be limited to 50%. You will be allowed a 100% deduction for these meals. Just want to touch here on the charitable entities and whether or not when you donate to a charitable entity, it should be considered a charitable contribution or if it should be actually reclassified as something else. So taxpayers could benefit from the contribution of money to an organization where they're maybe on this, you see in the background here, there's a flyer, and on that flyer, maybe you are the lead ad of that, and really the contribution was in good faith, but the amount of advertising you were getting was highly beneficial. So that could be reclassified from charitable contributions to, say, advertising expense. Payments in exchange for state and local tax credits. And just wanted to note on this, if you did apply for those, you must reduce the charitable deduction that you receive by the amount of state and local tax credit you received during the year. And this would be for businesses, pass-throughs, C-Corps. And last, talking about Section 165I election. And what is that? It allows taxpayers to accelerate current year casualty disaster losses into the immediately preceding tax year. And this is a great tax planning option for taxpayers in 2020, where you may have had these large losses, but in 2019, you may have had taxable income, a huge tax bill, where this election would allow you to take these losses that you experienced, depending on what the character of that loss was, in 2019, amend a tax return and have some money come back to your business. And want to note here, the individual C corporation amended tax return deadline would be October 15th, 2021. And for non-BBA partnerships and S-Corps, the amended tax return due date will be September 15th, 2021. So just keep those in mind. And with that, that's the end of our section. If you have any questions, we will be taking those. You can send those directly to the speaker leaders, or I guess the everyone chat, but we'll be handling them at the tail end of the presentations today.
Thanks, John. So we're going to turn this back over to Kirk to introduce the next speaker.
Yes, thank you. And we want to thank you for that presentation. Fast and furious, a lot of great information, but yes, please put your questions in the chat, and then we'll pick those up and cover them at the end. So we'd like to welcome Shannon and Associates, and we're excited for your presentation. So Laura, go ahead, and Bridget, you can share the screen.
Hi everybody, I'm Laura Koenig. I'm a senior tax manager at Shannon and Associates. We're a CPA firm in Kent, and we're going to be covering two main topics. One is what potential tax law changes, either estate, income, state and local, could be happening as we have a new president-elect coming in, and also a Democratic House and Senate. And second section we're going to cover is kind of some manufacturing specific tax planning ideas. We're going to talk about depreciation, cost segregation, research and development credits, and employer tax credits. And then we also, we're just going to touch briefly on the new 1099 NEC, which is replacing the 1099 miscellaneous for certain types of payments for services. So, and like everyone said, if you have questions, go ahead and put them in chat, and we're going to circle back to those questions at the end of all of the presentations. So, as everyone knows, with the Georgia runoff election that happened on Tuesday, we now have a democratically controlled House and Senate, and with President-elect Biden coming in, who's also a Democrat, it's widely understood that with the current deficit and the current spending programs for the PPP Act and some of the other stimulus programs, that it's very likely that we'll have some tax increases in probably 2021, but certainly sooner versus later. I don't think it's a matter of if, it's a matter of when. And so we've done some research on what some of those potential changes would be. And of course, we don't have a crystal ball, so we don't know if these will actually happen or when they'll happen. But it's important for businesses to make some thoughtful decisions for 2019. I'm sorry, for their 2020 taxes versus their 2021 taxes. And also for business owners to be thoughtful about some things they might want to be doing. So first one is the corporate tax rates for C corporations was reduced to from 35% to 25 to 21% about 3 years ago. And that flat rate tax is set to expire in 2025. One of the proposed tax increases is having that tax rate go back up to 28%. So businesses that have C corporations should be watching for that. And I'm going to circle back to what are some of the tax planning opportunities that businesses can do to manage that tax. There's several expanded energy related credits related to carbon capturing, greenhouse emissions and things like that. Another one is going to be important for business owners that own their businesses through S corporations or LLC partnerships or Schedule Cs, that the QBID deduction might be phased out for filers, married, filing, joint filers with income over $400,000. So when they put into effect the 21% flat C corporation tax rate, they also created the QBID and the QBID qualified business income deduction. The QBID deduction basically brings the top individual tax rate for business income down from 39.6% to 28%. So for business owners that have profitable businesses for 2021, potentially the QBID could be going away for those business owners. And $400,000, for most business owners, this is going to be wages, their pass-through income, their investment income. For most business owners, $400,000 is not a particularly high threshold. So with the QBID going away, now we're going to be paying tax on pass-through income at a rate higher than 28%. You can go ahead and go to the next slide, Bridget. Thanks. The maximum tax rate for individuals with income over $400,000, married, filing, joint, right now is 37%. It's expected that that could go back up to 39.6%. And that the long-term capital gains rate and the qualified dividend rate could go from being a flat tax of 23.8% up to 39.6% for income of, for married, filing, joint income over $1 million. So that doesn't seem like that would be all that big a deal. But if a business has a transaction where they're basically selling a business or a business segment, it could be very easy to be triggered over $1 million. So businesses that are contemplating selling are going to want to watch this one and might want to accelerate their timing or break their payments up to manage this kind of floor threshold. So that's going to be something to watch. There's also potentially going to be some phase outs. You know, phase outs have been around since Bush the first said, no new taxes. In that particular year, there were no new taxes, but what there were takeaways. And so phase outs that was the beginning of the phase outs on itemized deductions or the takeaways. And we've had phase outs in and out for the last, probably 20 years. But there could be potential phase outs of itemized deductions over $400,000. There's potential expansions for child and dependent care credits and also for child tax credits. Here's another big one. Right now, the estate and the gift tax exemption from federal estate taxes is around $11 million per person. So that means you could have assets in your estate under $11 million and pay zero federal estate taxes. You would still have Washington state estate taxes potentially, but not federal estate taxes. And your tax rate for your estate over $11 million would be at 40%. The proposal is to back those numbers back down to the 2000 and can't remember what year it was, but they have a specific year that they're targeting. And in that year, the federal exemption for estate tax purposes was $3.5 million, and the rate was 45% per person. So what does that matter to business owners? Well, it's time to revisit your estate planning program with your estate attorney and your CPA, and to be thinking about tax planning opportunities to manage your federal estate taxes. If you could go back one, Bridget. The other thing to think about here is that when tax laws are changed, they're typically effective two different ways. They're either effective the date that the law the bill is proposed, or they're effective on a date that is decided on. Rarely are they retroactive to the beginning of the year, although they can be. So and the reason I'm bringing that up is that there is time to act on some of these things still. There was a big run at the end of the year to do estate planning, to do some other, aggressive tax planning. That window is not closed yet. So people need to at least have some conversations with their team about this. Okay, and I'm going to turn it over to Bridget Taylor in our office, and she's going to talk about the next few slides, and then we're going to switch back.
Okay, so the first thing that I have to talk about is the Washington Department of Revenue updates. There's not a lot of huge changes since Governor Inslee came out with some of the relief for that. So all that has happened so far is that there's been an extension, relief from penalties, penalty fees, interest, and the due dates. So there's a lot of lenience on that currently. This extension will terminate when COVID-19 state of emergency is over, or January, I believe that says 19th, sorry, the screens are in my way, January 19th of 2021, whichever comes first. So looks like January 19th is probably going to come first. So we'll see what Governor Inslee does for the extension of those reliefs for the Washington Department of Revenue. This relief is for any taxpayers that have been affected by the COVID-19 pandemic. Some tax changes in different cities I have researched a little bit about. The city of Auburn, there is a proposal to enact a B&O tax starting in 2022. The Auburn City Council is set to vote on this proposed B&O tax this first quarter of 2021. So we'll probably hear about that. And if you're in the city of Auburn, just keep an eye out for that potential new tax to come out. The city of Seattle has a new Jumpstart Seattle tax. This was also known as the Seattle payroll tax or the Amazon tax. It became effective January 1st of 2021 and will go through January 31st of 2040. This applies to payroll sourced in the city of Seattle. So there's two conditions to meet here. This is payroll of more than 7 million annually and employees earning more than 150,000 annually. Currently, the Seattle Chamber of Commerce has filed a lawsuit over this payroll tax. So it's a wait and see what happens with this one.
So that's back to me. Depreciation update for 2020. John mentioned the 179D is now permanent for energy efficient lightings. That's related to warehouse lighting. And there's, I think it's a $100,000 deduction available for that. There's certain specific things that you have to have in order for that to qualify, but it's definitely something the manufacturer should be reviewing. And Section 179 has been a high number for quite a long time. It's the ability to accelerate your depreciation in the year of purchase and acquisition of personal property, equipment that can be moved for vehicles, fleet vehicles. And that's $1,040,000. Your purchases for the entire year can cap that out if your purchases exceed $2,590,000. bonus depreciation, which is the ability to completely take 100% depreciation on all fixed assets except 39-year assets, was increased to being applicable, for used fixed assets as well as new fixed assets. And anything that has an asset life of 3, 5, 7, or 15 years would qualify for this depreciation. That's important for a number of reasons. I'm going to circle back to that on the next slide. One of the things that happened with the CARES Act in 2019 was that, 2020, sorry, was that a technical error that was made on the 2017, it was the TAJ, whatever, Act. There was an intent that, I guess it's called the lessee's depreciation improvements. There was the intent that if a tenant moved into commercial real estate space and did major leasehold improvements, that those leasehold improvements would be eligible for bonus depreciation and therefore 100% depreciation in the year of acquisition and placing in service. But the technical flaw, the way the law was written, it didn't work. And so those assets had to be capitalized over 39 years and depreciated over 39 years. Well, the 2020 fix in the CARES Act made it clear that we can now go back and correct those depreciable assets to a 15-year asset and take bonus depreciation and Section 179. And the type of improvements that would qualify are improvements made by the taxpayer to non-residential real property that are not structural, not an enlargement of the building, or to elevators or escalators. So an example of that would be, an accounting firm moves into a space in downtown Seattle, and they do $1 million rehab of the inside of the space in order to make it usable for their purposes. That $1 million could immediately be expensed. You would fix that by, there's two ways you can fix it. You can go back and amend, or you could do a change of accounting with filing form 3115 in the year that the change occurred, which would be 2020. And when you do the change of accounting, the form 3115, you get to take the tax benefit of that correction all in the year of change. And that can be a very large deduction. So all companies should be reviewing their fixed asset additions for 2018 and 2019 and their large leasehold improvements, and making sure that the only things that are capitalized as 39-year assets are things that don't qualify, which would be structural improvements to the building, load-bearing walls, that type of thing, and that there's enough details available to the accountants to properly depreciate those assets. So that's going to be something we're all going to want to do with our clients this year, and all business clients should be looking at that. Go ahead, Bridget. This is not new, but this is something that's still relevant. All businesses have the ability to set a capitalization policy. Their capitalization policy needs to be the same for their GAAP financial statement. And whatever they set for their GAAP financial statement, then they should use for their IRS expensing purposes. So for example, if a business decided that they were going to have the capitalization policy of $2,500 per item, then they would expense all fixed assets that were purchased that were under $2,500 per item. And so, for example, the computers that we buy, the chairs, the small fixtures, racking system, the trays and for racking systems. There's a lot of things that are under $2,500 per item that we could expense directly instead of capitalizing. Your capitalization policy has to be in writing, and you have to follow it for GAAP and tax. So if a business doesn't want to have large depreciation related to this, then they would want to set their capitalization policy at a lower number. So it's something to think about, and it has to be documented, it has to be in writing. Next slide. Thank you. This is also not a new idea, but it's still super important for businesses. The law has evolved with case law over time, and the IRS has pretty much acquiesced on it, that your depreciation on your building structures that are used for your businesses, so your commercial real estate, should be broken down into building components and then separately depreciated based on the life expectancy of those assets, which is set by the revenue procedures issued by the IRS. But you have to go through the process of breaking the assets out. There's a number of ways to do that. One way to do that is a cost segregation study, where you hire an engineering firm or an accounting firm with a cost segregation specialist group, where they use engineering studies to figure out the replacement cost of the assets and prepare a report that says what assets are 5-year, 7-year, 15-year, and 39-year. So for an example of that, traditionally we would capitalize the building, split the land out, and we would capitalize the building and be depreciating it over 39 years. We've had the opportunity for a number of years to go back and correct that and break the assets out into their components. So for example, land improvements to the land around the building, the yard around the building, the parking lot, the drainage systems, the lighting, the paving, the striping, and all of those things that are land improvements are 15-year assets versus 39-year assets. The fixtures, the bathroom fixtures, the office meetings space fixtures are 5 years. So if you haven't done this with your accountant, you really need to review this and take advantage of this. It's kind of a no-brainer. It's been around for a while, but you know, we're still running into business clients that haven't done this yet. Bridget's going to talk about this.
So next we'll talk about the research and development tax credits, or in the R&D tax credits. So what is the R&D tax credit? This is a credit for businesses that do any of the following. They develop or design new products or processes, enhance existing products or processes, develop or improve upon existing prototypes and software. So to claim the tax credit, there's quite a bit of documentation that's needed, and some of that documentation can include payroll records, general ledger expense details, project lists and notes, and employee testimonies. And this is to qualify that research activity as mentioned in the previous slide. The documentation is used and then calculate the credit and report it on Form 6765 with the tax return. The benefits of the credit, so this is a dollar for dollar credit against federal and potentially state taxes owed or paid. So this is a good credit to take advantage of. The credit can be calculated 2 different ways. The traditional method, which is 20% of the qualified research expenses over a base amount, or the alternative simplified credit method. This is a percentage of the average qualified research expense over the last 3 years. Businesses can take the credit for all open tax years. So this is a cool credit because if you can get the documentation necessary, you can go back for the open tax years and take a credit, amend the returns and take a credit against the taxes that were potentially paid. Also, a good thing about this credit is that it can be carried forward for 20 years. So if you can't take advantage of the credit in that year, it can be carried forward. Now I'll talk about the working opportunity tax credit. So what is this credit? This credit is for hiring qualified individuals in certain areas. So veterans, recipients of certain needs, so temporary assistant to needy families, supplemental nutrition assistance program, and supplemental security income, residents of designated communities, individuals referred from vocational rehabilitation centers, ex-felons or long-term unemployment recipients. This tax credit was scheduled to expire in December 31st of 2020, but has been extended for 5 years until 2025, which was previously mentioned. This tax credit has been extended year after year for the last few years. How to claim the credit? So the employer must obtain certification before claiming the credit. To do this, you file a Form 8850 with the state workforce agency or your payroll providers within 28 days after the eligible worker begins work. Once you get that certification, then you can calculate the credit. It goes on Form 5884 and filed with the tax return. The benefits of the credit: this is also a dollar for dollar credit against federal taxes paid or owed. Some states also allow this credit too. Credits can be up to $9,600 for each qualified employee, and the credit can also be carried forward for 20 years. I think this working opportunity tax credit is one that is underused by many businesses. So if you think you're able to hire any of those qualified individuals as listed by the IRS, it's definitely something to look into. So the 1099 NEC or 1099 is the NEC, non-employee compensation, is used in replace now of the 1099 miscellaneous. So this is a change for the 2020 filings. If your business paid more than $600 in a year for services performed, these amounts now get reported on the 1099 NEC instead of the 1099 miscellaneous. So there's a little chart here that explains potentially what goes on which form. The due date to the IRS for the 1099 miscellaneous is February 28th, and then the due date to the IRS for the new 1099 NEC is January 31st. And I say new, but it's not actually a new form. It was around many years ago and they just brought it back. So what and where? So rents, prizes, awards, other income, fishing boat proceeds, medical healthcare payments, corporate insurance proceeds, payments to attorneys, and the non-qualified deferred comp goes on 1099 miscellaneous. And then the other things not listed: professional fees, attorney for services including repair parts, commissions, payments to independent contractors or director fees will now go on that 1099 NEC on box 1.
So I want to circle back and pull two pieces together for everybody to think about, and then we'll wrap up our presentation. At the beginning of the presentation, we talked about potential tax law changes related to the income tax rates for C corporations and pass-through shareholders of businesses. And then another part of the presentation was talking about depreciation, section 179, accelerated depreciation, and bonus depreciation. So 179 and bonus depreciation are a little bit like spigots on a faucet. You can turn them on and off. You can pick and choose what assets you want to take those accelerated depreciation benefits for. And I would ask everyone to be very thoughtful about whether we turn the spigot all the way on and we take 100% of those depreciation write-offs for 2020, or if we turn the spigot partway off, or we pick and choose, because if our tax rates are higher in 2021 by 5 to 10%, then we've wasted a bracket there of tax rate. So for example, if we leave $100,000 of depreciation to move from 2020 to 2021, and the tax rate for a pass-through shareholder has gone from 28% to 39%, we're saving 10%, which is $10,000. So when we are doing our tax calculations this year, we're going to want to have a thoughtful conversation with our clients And our clients should be having a thoughtful conversation with their CPAs about, is the spigot all the way on? Are we taking all the depreciation we possibly can, which has been the model that we've all been using for the last 10 years. We don't even talk about it, we just do it. Or do we want to pull back on that spigot a little bit and leave some depreciation for future years? That's going to be the business owner's decision. It's not the CPA's decision. It's a thoughtful communication between the team. So I would encourage everybody to do that. We're right on our time. So we're going to turn it over to Kirk, and he's going to introduce the next speaker.
Yes, thank you so much. And just a reminder that this is being recorded, and we're going to post this on LinkedIn. We'll post it on our website, and make certain that everybody has a copy of this, because there's so much good information coming. It's a lot, and it's a lot fast. So with that, thank you so much for the presentation, and would like to hear next from Ashley Wong from the Equinox Business Law Group. And so Ashley, you can go ahead and share your screen.
Yeah, thanks so much, Kirk. So I'm going to be giving the general sort of legal update, what's going on in the legal world and what are we expecting here in 2021. Of course, our regular legal disclaimer, this isn't legal advice. Talk to a lawyer about your specific circumstances before taking any action. So some of the areas that we're going to cover today are just a general employment law update. We are also going to talk about remote employees and telework specifically, because obviously we're in a world where remote work is now more of the default, and where I think before it was more of the exception. We're also going to talk about COVID compliance audits and what to expect in sort of coronavirus 2.0, and then we're going to hit on data security at the end. So for the employment law update, what we're seeing here is a lot of trends. This is obviously 2020 was a unique year. We saw that there were, several large-scale events that really impacted employers universally. Specifically the coronavirus and the Black Lives Matter protests. And so I think those things are really going to shape workplaces going into 2021. So specifically, we're seeing a lot of increased protections for employees in the discrimination front, and a lot of activity in the DEI world of employers really making a concerted effort to increase diversity and equity in their workplaces. And then, of course, heightened awareness on issues like employee safety, and then, of course, remote work, which we're going to touch on here in a bit. So I do want to highlight, this year is a little bit different. Last year, we saw a slew of, just a bunch of different employment laws that went into effect, January 1st of 2020 or later in the year. And that is not really the case this year. There are, of course, a few updates that we should be prepared for, or that have already happened as of January 1st of this year. But I do want to just hit on a few of the highlights, because we do see businesses who may or may not have been aware of some of the changes that happened in 2020. One of those changes in Washington specifically, as well as other states around the country, is the Crown Act. So I believe it's somewhere around 14 states now that have implemented a similar legislation. The Crown Act is an act that prohibits discrimination of employees or applicants based on hair texture or protective coverings that are generally associated with race. So dreads, afros, braids, hair coverings, anything of that nature. So that is now a new protected class here in the state of Washington, as well as other states. It's just a new thing to be aware of that applies to both employees and applicants. Of course, paid family medical leave benefits became available in 2020. The employee premiums would have been started to be taken out of employee paychecks in 2019, but the benefits became available in 2020. I know we saw a large swath of employees who were taking paid family medical leave, much more than was expected. If you don't already have policies related to paid family medical leave, we do highly recommend that you update your employee handbooks, update your employee policies with respect to how this leave applies. And there are some unique some decisions that you may need to make that would be unique to your company, especially with respect to how paid family medical leave interacts with other types of leave that you offer. So whether that be sick leave, vacation, PTO, if your company is big enough to be covered by FMLA, then you'll want to consider how paid family medical leave works in interaction with those different types of leave. Yeah, so then next, I would say the salary history ban is one that probably most folks were aware of. You cannot ask employees or applicants for their previous salary history. There are a few exceptions to that. In addition, there are some requirements with respect to disclosure of expected compensation or anticipated compensation for a role once an employee or an applicant has been offered a job. And so there are some rules around that to be aware of. If you're not already aware of those, feel free to check out, I'll link some blog posts at the end of this presentation that will be sort of an easy kind of go and check those out. Of course, we've seen OSHA and COVID safety requirements. There are, of course, some new requirements, but a lot of this is just being aware of requirements that have been in place forever. So we have to have safe and healthy workplaces, and where it maybe wasn't as much of a concern for you in a regular office space to provide a safe and healthy workplace. Now, all of a sudden, you're really having to focus on your safety requirements. And so, of course, there are going to be some that are specific to COVID, like the mask wearing requirements. But just generally speaking, being aware of how COVID affects your workplace, it really is unique to each employer. The FFCRA, Shannon and Associates already touched on sort of the tax credits that are available here. And so, sick leave is still available through March of 2021 as an option. So after December 31st, it's no longer a requirement to offer sick leave, but it is an option that employers can take advantage of and still be able to receive the tax credit through March. And then this year, we have seen a few updates. So some of those updates include, of course, regular increase in minimum wage. We have seen also, this is a pretty major one. If employers are not already aware of it, you will want to make sure that you review your employee payrolls with respect to the exempt employee salary threshold increase. That's a mouthful. So as you are probably aware, employees are either going to be classified as exempt or non-exempt from minimum wage and overtime laws. There are certain requirements in order for an employee to be considered exempt from minimum wage and overtime laws. Specifically, there are tests with respect to the duties that the employee performs, as well as the way that they're paid. So employees do need to be, particularly what we call white-collar employees, need to be paid on a salary basis. And that salary level, there are both federal and state thresholds that you must meet in order for the employee to be considered exempt. This is the first year that the Washington threshold is going to exceed the federal threshold. And so employees are going to have to meet the Washington threshold in order to be considered exempt from minimum wage and overtime laws. So it's different for employers between who are 50 employees or fewer and employers who are over 50 employees. And there is a schedule of increases that will run through December or through 2028, excuse me. So as you can see for this year, employers with between 1 and 50 employees, the employees who meet the duties test and a salary basis test will need to have a salary threshold of at least $42,712 per year. And for larger employers with more than 51 employees, or 51 or more employees, that number is $49,831 per year. So you can take a look. Again, we have a blog post that links to the specific L&I schedule for what that looks like from this year all the way through 2028. We already touched a little bit on the City of Seattle local payroll expense tax. And then this is a really new update. The U.S. Department of Labor last year in the fall released a proposed test for whether a worker is an employee or an independent contractor. This has been an ongoing conversation. And if you're familiar at all with the question of whether somebody is considered an employee or an independent contractor, you would know that the test is going to be different depending on which government agency or organization that you are asking. So the IRS, for example, has a different test than the U.S. Department of Labor, has a different test than than Washington State L&I, for example. So here is the the U.S. Department of Labor's test. So this is going to be fairly new, and it's actually going to be going into place 60 days from today. And that test is an economic reality test. So whether somebody is considered an employee, like a W-2 employee versus a 1099 independent contractor is going to be determined based on a test of economic reality with two primary factors that are going to be considered by the DOL. The first factor is the nature and degree of how much control the worker has over the work that they're performing, or how much control, another way of saying that is how much control the employer has over the way that the work is performed. And then the second is the opportunity for profit and loss. So what we see a lot of the time is, folks who say, okay, well, can I just classify them as an independent contractor? They want to be paid as a 1099, for example. Well, it's not necessarily as simple as just, signing an independent contractor agreement and calling it a day. They do need to meet this test, and the risk of not meeting this test is a fairly high risk, because you can end up going, owing back taxes, back employment taxes. So there's a large risk there for misclassification. So we want to be careful that we are aware of how we are classifying our employees. So remote employees, moving on. This is, I think even before we jumped on this call, or before the call started, we were chatting about, a lot of folks have people who are working remotely. This has become the norm. I am currently at home. So that's something that, is going to be pretty much universal for anyone who has employees who are in a position to be able to work from home, is now almost a preference, I would say, for most employees. So we were kind of thrown into this in 2020 without much of an opportunity to really consider the best way to do it. We had just kind of had to figure it out. Employees now have to work from home. So maybe we threw together some policies and some processes, to make that happen initially, but it may not have been as thoughtful as we might have liked it to be. So now that we're in 2021, we really have an opportunity to refine those policies, refine those the processes and the practices for having employees work from home. And there are a few different issues that we want to be aware of here. The first, of course, is being, what is our policy on employees being remote? Are we going to be a remote first workplace where the expectation is that people are working from home, or from wherever they happen to be at that moment? Or are we simply remote friendly, where we allow employees to work from home, either entirely, 100% of the time, or some other percentage of the time, every other Friday or something. So considering what your policies are, and then making sure that those policies are in writing and clearly communicated to employees so that they know what's expected. Flexible work hours is another, and work locations is another element of work from home, or remote or telework. So that's just another element to be aware of. Out-of-state employees. This is a really, really big one. We've had a lot of folks who have had employees who have gone out of state either to visit family or to be with family, either temporarily or permanently during COVID, as well as employees who just wanted to move to Hawaii, or move back to their hometown, and so this is going to be a question of risk tolerance, essentially. So, we're going to have the very low end of the spectrum where the employee is going to work from their hometown for 3 weeks. I would say in that case, it's pretty fair to say that the employee is still, if they were previously, residents of Washington, is probably still a Washington resident. There's, almost no risk that the employee is going to be considered an employee of another state. But to the extent that that becomes more permanent, so, we're in 10, 11 months now of COVID-19. So if those employees have been gone for, 6 or more months, then we need to start considering, is that employee now considered an employee of another state? So if they go to live in Bend, Oregon, well, now they're an Oregon employee, and Oregon, of course, has employment taxes and things that we need to be. They also have different employment laws, so we have to be aware that the employee is going to be governed by the laws of the state where they're considered a resident, and so making sure that we're aware of how that affects our policies. For a lot of employers, we are recommending that you review your employee handbook and make sure that it does comply with the laws of any state where you have employees. And that may mean creating addenda to your handbook that address specifically the laws that apply to employees in that state. The other thing that we're seeing here is, of course, cybersecurity, the investment in technology, making sure that your confidential information is secure and that employees have a safe and secure way of accessing your information. And then just, of course, the ease of communication with each other. Obviously, we're on a Zoom call right now. I know that we're all using, Zoom and Teams and all of the various options. So hopefully that's something that you figured out by now. Fostering connection and culture. This is more of an extra legal, I would say, not legal, but more of a cultural, is just making sure that we're staying connected and keeping morale high. I would say that there's a lot of competition in the employment space right now, purely because of the flexibility that employees have now to look elsewhere for employment. So keeping morale high and making sure that we're all staying connected, I think, is just important as well. And then making sure that we have all of those things written down in our policies, and that our policies are being distributed to our employees in a way that is accessible for them. One thing that I didn't put on this list here is signage. So this is maybe a tangential consideration, but of course, we're going to have our regular employment policies. Most of us have a break room where we have employment posters up on the wall. We don't have that anymore when we're all working remotely or teleworking. So we want to make sure that we are that our employees do have access to that in some form or fashion. So if you have an online document system or something like that, you can maybe create a space where you can distribute those required notices. Coronavirus 2.0. All right, so here we are in 2021, and we are all still being impacted on a daily basis by COVID-19. So again, this is something that we were thrown into it. We had to figure it out, and I'm sure we all have some semblance of policies at this point in place to address COVID-19. And so now is an opportunity to make sure that our policies are really refined and that we've really thought through what they mean. We're also going to talk a little bit about audits and what to expect and what we're seeing on the front of COVID audits here in Washington. So of course, with our compliance infrastructure, it's going to start with written policies. These policies are not going to be a one-size-fits-all. They're not going to be a universal standard. What we really need to do is make sure that you're looking at your workplace and considering what are the different types of roles with your employees, how are they interacting, what are all of the different regular touch points, both physical touch points as well as when employees interacting with each other. So making sure that we're maintaining all of the regular social distancing and masking protocols that are required, signage, room occupancy limits, and folks are putting arrows on the ground so that kind of managing traffic patterns in the workplace. So there are all those kinds of things to consider, and so it's really going to be specific to your space and your employees and how they interact. Audits. We are seeing audits. So audits are currently happening. They're typically going to be triggered by complaints by employees or customers or members of the public who believe that there's instances of non-compliance, and that's what we've seen is that a complaint has been submitted to the Department of Safety, and so they come in and they do maybe even a surprise visit to your workplace, and so what are they going to be looking for? They're going to be thorough. They might require you to allow them to perform a walkthrough of your space, so that's something that you should expect. They're going to be looking for folks, if you have sanitation available at the front desk, if you're having people use the same pen, if your employees are practicing social distancing, if they're in the lunchroom without their masks on, all of those kinds of things they're going to be looking for, and they'll let you know if they see it. They're also going to ask for written policies. There are requirements around training as well. And so they're going to ask for historical documentation of what policies have been distributed to your employees. Have you been documenting any training that you've been doing with your employees? Have you been documenting attendance of those trainings? So as much as you can, bolster your files with documentation showing that you have been in compliance. Even if you have been doing trainings, but you haven't been documenting those trainings, it's going to be hard to show should they come and ask for that documentation. So those are some of the things that we want to be aware of course, all of the regular safety protocols. And as these things are continuously being updated. You know, we've seen a number of different updates from the CDC and the Washington Department of Health, kind of, you know, leveraging the CDC research as to what the expectations are for when employees are allowed back into the workplace after they've received a positive test or had some level of exposure. And so what that looks like. And so we want to make sure that we're kind of staying up to date every day with credible sources as much as possible. So I did provide a few links at the bottom of this slide to some helpful information in case anyone would like to have that. All right, and finally, we're going to touch here on consumer privacy and data security. So here we are seeing patchwork of state legislation. You know, you might be familiar a little bit with Europe and the GDPR. They've got sort of one regulation that governs all of the different states, and that's not the case here. We don't have a regular federal legislation that relates to consumer privacy and data security. What we have instead is a few states that are really leading the charge in this area, and they are setting the standard. So in particular, California. So what we saw this year was the California Consumer Privacy Act came into effect. This may or may not impact your business. There are specific tests that need to be met in order for your business to even have to worry about the California Consumer Privacy Act. And so that's, I'll touch on that in a second. So that's this patchwork of legislation is a huge challenge, because that means that we're looking at 50 different states with 50 different rules. And so which state applies to my business, and how do I know what rules to follow and what rules I even have to follow? It's a lot for a business owner to keep track of, even to look at it and say, okay, yeah, that doesn't apply to me, and feel confident about that decision. So we're seeing a large increase in security investment, regardless of whether data security laws apply to you. The reality is that we live in a time where data breaches and phishing attacks are commonplace, and it's a matter of when and not if, really. And so training our employees on phishing and how to prevent a phishing attack, and putting in place certain protocols to make sure that you're not as high of a risk for that is going to be a really important step to take, even if one of these laws does not apply to you. ADA accessibility. So what we're seeing here, increased activity in the ADA accessibility space. Anyone who has a website that's considered a place of public accommodation, which in and of itself is a debated topic, is going to, what we're seeing is folks who are getting demand letters from plaintiffs groups, essentially. They send out 50 or more demand letters in a day to 50 different websites saying, hey, your website doesn't comply with the ADA. My client can't access your services. And so, we expect you to engage in settlement discussions with us. And that usually ends up in some form of a settlement that results in some level of payment, as well as actions that you need to take to get your website into compliance with the ADA. And so even if the complaint is not necessarily strong or founded in a basis of law, it becomes a headache, and it becomes something that you now have to address. And so to the extent that your website is a place of public accommodation, then that's something that you'll want to pay attention to. And of course, with this patchwork of laws, we are hoping for comprehensive federal legislation in this area, but we may or may not see that. There have been a number of efforts, but nothing's really stuck so far. So I will touch on a few of the states that are seeing this privacy legislation. Of course, California is the first one here. I would say that to the extent that multiple privacy laws apply to your business, I would go and comply with the law that is most restrictive or the most protective for the consumer. For the California Consumer Privacy Act, there's a different series of tests that you'll need to apply to determine whether it applies to your business. Specifically, you need to be doing business in California. So what does it mean to be doing a business in California is one question that I won't get into here, but certainly contact an attorney if you're unsure if you're considered to be doing business in California. And then if you meet one of three tests, the two primary tests that I would say are going to apply to most businesses are if you have $25 million or more of gross revenue, or if you are collecting data of 50,000 consumers, households, or devices. Now that 50,000 might sound like a really big number, but if you kind of break it down, it's really not that many. So for example, devices, if I access your website from my laptop and my cell phone and my iPad, that's 3 different devices. And so that number can really, can grow really quickly. I want to say it's somewhere around 136 unique users per day. So we want to be aware of that. That's a quick threshold to be able to meet. So that's just whether it applies to you. That there is a lot here that I won't get into, but if it does apply, then there are a number of different steps that you're going to take, including updating your privacy policy. And if you're considered to be selling data under the CCPA definition of sale, then we're going to need to make sure that we provide an opt-out mechanism for any consumers for whom you are, quote unquote, selling their personal information. Now, California didn't waste any time at all. Before the ink was dry on the CCPA, they implemented the California Privacy Rights Act, which is going to replace the CCPA come January 1st, 2023. So even though we've just implemented this for the first time, just this year, here we are now having to look at what's next. So it's a very, very quickly moving space. There are quite a few differences between the CCPA and the CPRA. Specifically, there's a different test. So the 50,000 consumer threshold is increased to 100,000 consumers. There's a new category for sensitive personal information that makes it a little bit more similar to the European legislation, the GDPR. And then we also have created a new enforcement agency. So right now the CCPA is being enforced by the California Attorney General. There will soon be a new enforcement agency that will be tasked solely with investigating and enforcing the California Privacy Rights Act. Now, more importantly, the Washington Privacy Act. This is the 3rd year in a row that we will see a proposed privacy law for the state of Washington. So this is something we are keeping a very, very close eye on. We have failed a couple of times in the past, and there have been a couple of sticking points that have really been the primary driving force for that failure. And so TBD, we should know within the next few weeks really whether we're going to have any traction this year on that. But I think it's a matter of when and not if. So even if it's not this year, it could be next year. So we're keeping a very close look. Keep an eye on our blog, of course, and we'll be giving updates there. One of the big controversial issues here is whether there's going to be a private consumer right of action, which means if you were found to have violated the law, or if there is a data breach that results from a violation of the law, can consumers sue you and collect damages in addition to whatever other statutory damages might apply for the violation? So that's really been one of the big sticking points, of course, being a major tech hub like we are here in Seattle. It's going to be, again, just an ongoing argument of, the tech companies trying to make sure that, that there's not availability of a consumer right of action versus, consumers, the interest of consumers here. So I would say that the Washington Privacy Act, as most recently proposed, is really a hybrid between the California Consumer Privacy Act and the European General Data Protection Regulation. So the way that it's drafted is kind of a bit of a hybrid of those two. So again, you can find some information on that on our blog, and we'll of course be giving updates as needed because it's again moving very, very quickly. Okay, yeah, and then there are also, if you're not already aware, there are a few other privacy laws that went into effect last year. Specifically, there is one in New York related to specific types of data that are being collected from New York consumers. Nevada also has one as well if you are availing yourself of doing business in the state of Nevada. There has been a federal act that has been proposed. I don't think that there's really a ton of traction here yet, but we will, of course, be keeping a close eye on that. And then, I would say that this is by no means a comprehensive list of states that are taking action in the consumer privacy space. So there are quite a few different states that are really starting to make some progress here. So yeah, so we want to keep a close eye. If you are one of those businesses that is, for instance, selling goods in all 50 states, then you're going to want to take a look at what laws are applying to you, and how, for instance, each state defines doing business and things like that. So it's going to be different for every state, which is the challenge of having the patchwork that we have now. Okay, so the Equinox blog does have a bunch of different articles on some of the areas that I've touched on today. So you can head over to any of these links, or just go over to our website and hit blog, and you'll have the ability to scroll through those. We do have a few different events as well. So I'll just provide that information here. Again, you can just go to our events page to see that, but we do offer free webinars on different topics that are all going to be kind of centered around any of these topics that we've talked about today, including cybersecurity. So that's all I have for us today. Kirk?
Hey, well, thank you very much. If you could stop sharing the screen, and yeah.
Oh yeah. Let's see here. Stop share. Thank you. Stop share.
Thank you so much. Boy, this has been great. A lot of important and information, but all of you presented so well and so much, and all of you are such quality professionals. We're grateful to have you in the CAMPS community. So this is our opportunity to ask questions. So if you have questions, it might be more helpful to put them into the chat, although it's okay at this point if you want to come off of mute to ask your questions. So I know Stacy's gotten a couple of questions, and so Stacy, if you want to go ahead and ask some of the questions that have come up, and feel free to keep.
Okay, so this question, there's actually two and this is from Barbara from Lynn Larson. I don't know if she's still here or not. Regarding tenant improvements, if a city requires landscaping as a part of the permits for new non-structural offices and bathrooms, can landscaping qualify?
Yeah. So I can take that question. So yes, landscaping is considered a 15-year asset for depreciation purposes, as well as lighting, paving, stripping, the paint stripping, drainage systems, all of those exterior improvements to the land in order for the property to be usable.
Okay, and then she's also asking, well, first they've completed the cost segregation. Her question is, do you know if there will be changes in the new year, or are the rules that you mentioned the same?
As far as I know, the rules are going to stay the same. The last big change in this area was about 3 years ago. But there can be changes with case law on all of this, but the biggest change is on the qualified improvement property, which is related to tenants leasing space from others.
Okay.
Great.
I think this is for Bader Martin. Does the new required minimum distribution rules apply to both traditional IRAs and Roth IRAs? And also, are these rules permanent?
I'll take that one. Yes, it does. And within the act, it's permanent. However, that does not prevent a subsequent act to modify or change the terms.
Okay. If a company submitted a timely loan forgiveness application, do they have to make any payments on the loan prior to the SBA granting the forgiveness amounts?
I think that's for me. So as long as you submitted the loan forgiveness application within 10 months of the completion of your covered period that we talked about earlier, then your company is not required to make any repayments until your forgiveness amount is remitted to your company by the SBA.
Okay. Can businesses deduct meals and entertainment provided to employees for team building?
Yes, that's a good question. Yes, and there is an exception that applies to expenses that are paid or incurred for holiday parties, picnics, summer outings, and it's for the taxpayers' employees other than highly compensated employees. So I think this is a great opportunity too when you're trying to build morale and know that you're able to take advantage of that full expensing.
Okay. Are there any other potential tax law changes under President-elect Biden that we should be planning for?
I can take that one. One of the other potential changes is related to estate tax, and that right now when someone dies, their income tax basis of their assets steps up to the fair market value of the asset in their estate. There's a potential change to this in that there would no longer be an income tax basis step up. And so that means that any capital gain income would still be, would not basically disappear when the estate happens, when there's a step up in value. So for example, if the business owner has a business, the value of their stock would be includable in their estate. They would pay estate taxes on it. And then if their family then sold the business, they would then also pay income tax on the gain of that business as well. That is potentially going to be a huge change. I didn't include it on my slides because I think it might be too big a change, but it is something to kind of be watching.
Is it better to amend for depreciation corrections or take all of the benefit in the current year?
I think either John or I could answer that question, but the answer is it depends, which is, you know, the standard tax answer to almost any question. So it's a math problem, and is there more benefit in the prior year, or is there more benefit in the current year? That's question one. And then question two is administratively, if you amend a prior year, you're amending the business return, and then you have to amend the shareholder returns. If there's a lot of shareholders, that becomes administratively more expensive than taking a change in the current year with the 3115. So it's something that you need to be thoughtful about. John, you have something to add?
Yeah, I was going to say, and it could be costly. So it's definitely an analysis where if you have many outside shareholders, like you could be looking at your business, but what about how they're going to feel when you push out something that requires them to amend a return to?
Mm-hmm.
Sorry, I didn't mean to interject.
No, that was great comment. Appreciate it.
Okay. Some of the PPP loan forgiveness application forms have expiration dates listed at the top of the form. If we apply for forgiveness after the deadline at the top of the form, are we still eligible?
As far as I know, yes. I was looking at that actually this morning too. There's, of the forms they've released, there's several that just have a date, and there's a ton of forms obviously that change as legislation changes or circumstances change. So borrowers may still submit a loan forgiveness application anytime before the maturity date of the loan, and forgiveness is within 10 months after the last day of the borrower's loan forgiveness covered period. Loan payments are no longer deferred, and the borrower must begin to make payments on that loan. And I want to have an example here of if your covered period, yeah, I do. I was going to include something like this in the slide. This is perfect. Ends on October 30th, has until August 30th, 2021 to apply for forgiveness before the loan payment begins.
Okay. You discussed changes to charitable contribution limits for corporations. Were there any changes to me as an individual?
Yeah. So we did touch base on just on those cash contributions where there's a 100% offset to AGI, but there's also a provision where taxpayers that don't itemize are able to take advantage of charitable contributions and above the line deduction, $300 per individual, or married filing joint, you can take $600. So that's nice for everybody, especially with the changes to the Schedule A in general.
Okay. I was told that the AMT tax made my R&D credit worthless. Is that true? Is that still true?
I can take a shot at this, and then Laura, just jump in if there's anything I might have missed. So without getting into all the details of the alternative minimum tax credit, because the calculation is pretty detailed and complicated, I would say, you know, it depends on what's happening, but also that even that the AMT tax credit can limit the R&D credit that you take. But keep in mind, as stated before, that the R&D credit can also be carried forward for 20 years. So even if you don't get to take advantage of that credit in the current year that you're looking at, you can carry it forward and take advantage in future years.
Okay.
Yeah, and I would add on to that, there's an interplay between the two tax rates or the two tax systems that for a long time made the R&D credit kind of worthless. There were some changes that were made about 4 years ago with some of the thresholds that make the R&D credit worthwhile to more business owners. It used to be you had to have a pretty large credit to kind of get over some of the threshold limitations, and that's been dropped down. So it's, if you haven't looked at that for a while, it is worth looking at again.
I thought there was a provision where part of the credit could be converted to offset payroll taxes.
That's a good question. I don't know the answer to that off the top of my head. Do you know the answer to that off the top of your head, John?
John, you got that?
Yeah, I think there's some special rules for that. And I had a taxpayer recently that had that exact circumstance, and we had to analyze the type of R&D credit and whether or not the taxpayer was in a loss situation. But there are circumstances, yes, where you can do exactly that. The taxpayer that I'm referring to had that scenario, and unfortunately we weren't able to utilize that conversion based on their circumstances. But yeah, that's a really beneficial opportunity for taxpayers that could be in loss positions. The taxpayer I was having to look for, they couldn't benefit from it. So it was just, those credits just carry forward until they start generating taxable income. But again, it's something to look at. If you do meet those circumstances, you could realize that benefit even if you're in a loss situation.
It's good to know. Thank you.
Okay, that's all the questions that I have here in the chat. Does anyone else have any more questions? You can come off of mute if you do.
I was just thinking, Laura, while you were presenting, I kind of came up with a gap question, and maybe just posing it to the CPAs in the audience. But you said that the 21% expires, the 21% corporate rate expires in 2025 with a new proposed rate of 28. So when we are setting up deferred income tax provisions, GAAP says you're supposed to tax affect the temporary differences at the rate expected to be in place when they reverse.
Right.
So just kind of wondering what everybody's using, because I know we're using 21%.
Oh, we're using 21% also. So,
But if that expires and you have a temporary difference that you know isn't going to reverse until post 2025, technically you should probably use some other rate, but we don't know what that rate will be, right?
Right, right. And then you would be looking at breaking down your timing differences, like, for example, depreciation into when those reversals will happen, book versus tax depreciation, and then any other long-term book tax differences, and trying to make a guess on, that's a good pickle.
Yeah.
Yeah.
Yeah, I saw that, I think, with a, sorry to interject here, I saw that with a provision myself where working with someone that's very code oriented and analyzing the the deferred rates, and when he was pointing out, like, really, if we want to get like completely correct, we should be changing the depreciation. Looking at, I'm like, who in their right mind is doing that?
Yeah.
We're not.
Well,
We're using 21%.
Yeah,
Yeah, I think-
there is a degree of practicality you bring into that, but I think technically GAAP says you're supposed to look at each temporary difference individually to determine the effect. So anyway, just throwing that out there for all the GAAP heads, of which I'm one.
Well, I want to thank everybody. We don't, unless there's any other questions, I didn't see any other questions in the chat, but I want to thank all of you for being here and for this information that I think is so valuable to our camps members. And so I'm looking forward to putting together the recording and making this available. So I just want to remind everybody that camps is doing more things. We have a newsletter. I actually put that at one of the very first chats. So we have a newsletter. We are starting to do working groups. So we have an ERP working group. We have a marketing working group. And these are opportunities to get more involved with the camps community on these different topics. So we are looking for opportunities to help meet the needs of manufacturers. And so I also want to remind you that the investment that we make in knowledge together like this has the highest return. I think there were so many things that were shared today that were valuable. Plus, I think just getting to know, put a face to a name of these wonderful businesses that we have, getting to know somebody like Ashley or Laura or Steve, John, Bridget, you guys were great to get to hear your voices and see your levels of expertise on these topics. So very impressive. So with that, I'll go ahead and stop the recording and we can network for a moment.